Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend, Jack Gamble from the YouTube channel called Nobody Special Finance. Jack, welcome back.
Thanks, Ivan. Thanks for having me back on.
Yeah, pleasure.
So, Jack, the latest news, let's talk silver. Um, this is our good friend Michael. He puts together these great graphs on Twitter tracking the registered and eligible categories and some of the lowest levels in the vaults since going back to 2017 for registered. The level of leverage, open interest relative to the amount of silver in the vaults the leverage is getting, incredibly high. We wanted to talk about why, and you have a theory about this, about energy prices and where the actual refineries are, for where these good delivery bars are actually refined from the raw metal, the doré bars or the concentrate that the miners actually make. So walk us through your theory here.
So my theory is not that silver is going higher in the short term. I just want to say I still think, despite the trends in the supply right now and these declining levels in the Comex, I still think the overall chaos in markets is going to drag everything lower, including silver. All right. But I think silver is setting up to bounce really hard and really fast off the bottom when we eventually find a bottom. And one of the reasons why is this economic chaos is going to really limit the supply of silver entering the market. Now, silver, unlike gold is not as heavily dependent on mining. Gold isn't really consumed as much. You have some electronics use and some jewelry and things like that. But for the most part, gold circulates, right? It trades hands. Silver actually gets consumed. It ends up in the dumpster eventually, right? We make electronics, we make chips, all kinds of things have silver plating on it. And at least right now at these prices, it's not worth it to go recycle most of that stuff. So it gets thrown out. So silver needs a steady flow of new supply in order to keep the market liquid. And with what's going on in Europe right now, that supply is about to be significantly reduced. And that's not why we see the Comex drain right now, but I think the drain at the Comex is going to get a lot worse this winter because as we go through this list in the LBMA, this is good delivery. These are all the people who make those big, beautiful 1,000 bars that we all wish we had one, right? There's a lot of German names here. There's a lot of Italian names here. There's some in Spain, right? These are all countries that right now we're talking about deindustrialization in Europe. I mean, that's a really powerful word, deindustrialization. They're talking about these countries going essentially back in time by centuries, right? Pre-industrial eras.
I think we need to make a point as to why. The refining business is incredibly energy intensive, correct? It uses a lot of heat, a lot of natural gas for the melting process. This is not something that can even, using wind turbines or solar panels, that type of electricity is not useful for the refining process. They actually use natural gas for the heating and melting process to separate these metals from the precious metals from the base metals from the ore to get it to higher purity levels, correct?
Absolutely. It's incredibly energy intensive.
Energy intensive, and not just any type of energy, specifically natural gas and coal to create that heat and fire, correct?
Absolutely. Yep.
And coal
Now
prices
think
are
about
going
it.
through the roof. Coal prices are
going through the roof, right? So forget for 1 second the economics of this, right? Because energy costs are exploding in Europe. We'll get to that. Put yourself in the political position that they are the powers that be in Europe are going to decide who gets the energy this winter. There is not enough. And they've already implemented price controls. You know, they flat out said, because of political reasons, we're not going to let people's energy bills go this high. So the people in charge of things in the government, because they're controlling prices, what they're essentially creating is government mandated shortages. If you don't let prices rise, you don't get demand destruction. So the government is going to have to pick who gets the power and who doesn't in Europe. And who do you think is going to get the power? People who are freezing to death, people who are voting, or the big bad rich guy who wants his silver and his gold bars? I mean, if you're a politician, who are you going to cut the juice off to?
Well, I think if I were a politician in Germany and I had to decide who, and I have a limited amount of natural gas in the winter, and we have to start making, number one, the natural gas is probably 5 to 10 times more expensive than the 5-year average. And here, let me just show that chart real
That's
quick.
the lows.
So here's the natural gas chart. And you can see if you want to go back a couple of years in time, these people are used to being in the 15 to, what was this, back in 2020. So just 2 years ago, the average price was in the 13 to 14s. Now it's even after the pullback, we had these brief spikes up to crazy levels, but even after the pullback, it's still 10 times higher than what it was 2 years ago. So these are even here, right here today, these are insane levels of natural gas compared to what people are historically ready for. So the government's got to make a decision. There's not enough natural gas this winter. The pipelines have been blown up, so it's not being turned on anytime soon from Nord Stream. And regarding Nord Stream, we have our theories as to what happens at the Nord Stream pipeline. We have no idea for sure, just a theory.
How dare you!
We're not going to go there.
Yeah.
We're not going to speculate. But the market for natural gas is not going to turn around anytime soon. So the theory is here, when it comes time to winter, and even now, the German government, all the governments of Europe, they have to decide where the priorities are going to be if there is any sort of rationing of natural gas.
Right.
So,
which is inevitable right now. It's inevitable that there's rationing.
Yeah. So obviously, heating for people in the winter is going to be a high priority. Certain industries that are high, huge job creators, like the auto manufacturing, that will probably get some. They don't want auto plants shutting down. That just tens of thousands of people right there. But I think you're right. I think refining for gold and silver and certain other certain other metals are going to be less of a priority if it comes down to a rationing. Is that the gist of the theory here?
Yes, the energy curtailments in Europe will limit the supply because I think there's 81 of these LBMA good delivery refiners, and 18 of them are in Europe.
Wow.
Right. So you're talking, if they force this shutdown, almost a quarter of the supply of these bars is going to get shut down. Now, maybe some of the other refiners can increase their output to offset some of that, but I doubt they can offset that many of them.
Well, I mean, we're talking about the locations for where the ore is. Quite often, ore from Africa generally goes towards Europe, just because it's the shortest distance. So changing where you send your ore is a big deal. It's not necessarily easy to send ore from Africa, Northern Africa in particular. Let's say Morocco. I know there's silver mines there that send all their product to Europe just because it's just right across the Mediterranean. But instead of putting that on a container ship and sending it all the way over to China instead, it's a huge added expense.
Right.
And so what's the percentage? How much of the refining is done in Europe for silver and gold?
I don't know by the pound, just that 18 of the 21 refiners are there. Some of them may be smaller ones, some are maybe bigger. I haven't gone that deep into the actual tonnage here, but it is certainly a not insignificant number of the refiners that are in Europe. And we're already in a position where the Comex is being bled dry, right? We're like 42.6 million in the registered right now, and we're dropping on average a few 100,000 a day. So the ground's getting closer, and the rate of replenishment in the next few months is going to be reduced. I couldn't tell you exactly to what extent, but the rate will be reduced, and we're already in a situation where we're not keeping up with the withdrawals.
You go back a year ago, this number was 149 million. A year and a half ago, this was 149 million ounces.
That's crazy.
In the registered category. So it's dramatically, it's fallen by 2/3. If you look back at this over time, Comex and LBMA, this is another graph that Michael puts out, showing here's when the Silversqueeze began on this graph. Just over time, you can see the drain has just accelerated. And this is before Ukraine, before high energy prices. This was the Silversqueeze. But you can see this trend is accelerating. That number, it used to be 149 million ounces in Comex, but this is Comex and LBMA combined. It's not going back and forth in sort of any sort of arbitrage between London and Comex. It's just being drained out of both of them. And this trend seems to be accelerating. I don't know when this breaks. I know a certain amount of ounces are owned by the ETFs, and there's some ETF fuckery going on, as you told us, Jack. But what do you make of this? At some point, it has to become a problem for the leveraged, the people who are hedging or the people who are playing the futures of the paper market. At some point, the leverage just becomes insane when there's not enough physical ounces in the vault.
So when I see this chart, I see a spring that is being compressed, right? The price is being held down while the supply is being reduced. That's upward pressure being put on prices, but the price is not moving up. All right. So they're compressing this spring. However, they're doing it, through manipulation through the ETFs. And I know like the SLV is being shorted right now substantially. Meanwhile, the SLV is also bleeding bars. So they're draining the metal while suppressing the price, right? So there's some dotted lines you could connect there to say the price is being very heavily suppressed right now. Now, there's also some headwinds, right? We have asset deflation that's going on in the world. Got stocks are heading lower, housing's heading lower, right? So there's some things that are pushing the price down also. But as this supply continues to dwindle, this is putting upward pressure on the price. And I think we're going to see these red bars are going to start getting bigger, maybe not because people are buying it out any faster, but because the rate of replenishment is going to start declining. And that means the monthly changes in the inventory are going to get even bigger. It's going to get lower. And look, supply and demand don't change. So if you continue to exhaust the supply, eventually the prices will need to move higher. It's the only solution to higher prices, or the only solution to a shortage is higher prices. So the prices will have to rise. Now, markets overall, I mean, we're seeing some really big moves. We saw some really scary stuff going on in the UK the other day. So you have a major bear market that we're on the brink of right now, or you could say we're in the middle of. And I've gone back and I've looked. Historically, silver does go down in bear markets, right? It tends to outperform the S&P 500. It goes down less than stocks do, but silver also goes down when everything else is going down. So I expect the market forces to continue to pull prices lower, even though we're seeing the supply drain out. And that's good. That's a good thing, because that means that bounce off the bottom is going to be harder and faster. When the market finally does find its bottom, which I think is way lower from here, that bounce is going to be hard and fast, and you want to be well positioned when that happens.
So don't buy the dip yet. You think the dip is buy the dip's coming.
Dip buying has this negative connotation to it these days. DCA the dip, all right? Average the dip.
Yeah, there we go.
You're not going to nail the bottom. Nobody's that good, right? Don't nail the bottom. You don't have to nail the bottom, right?
Right.
If you buy silver at 16, and if you buy it at 15 and 17, and if you buy it all the way down at 11, sorry, Jim, I heard your pulse get a little higher there when I said 11 again. All right, if you buy it all the way down there, when it goes to 50,
got my blood pressure medication. I'm
there you go. But when it goes to 50, are you going to care if you bought it at 11 or 12? Maybe a little bit, right? But just don't. I always tell people, don't pile in all at once, right? Take nibbles, take bites.
Well, Jack, thank you very much for joining us. We appreciate your take on things, and we'll talk to you again in the near future.
Anytime, guys. It's always a pleasure. Thank you.